Welcome everyone to Talking Data. I'm Kristen Radosh of Arbor Research and Trading, and I'm joined today by Jim Bianco, Bianco Research, and Ben Breitholtz of Arbor Data Science. Today we're going to be talking about the very hot topic, inflation. Jim, why don't you get us started? We'll talk first about the case for inflation.
Yeah, so the case for inflation, I think, comes down into a couple of parts. The first part is booming commodity prices, although that will also be in the case against, which we'll talk about in a second. But across the board, commodity prices are going higher, whether it's grains, whether it's industrial metals. About the only two things that are really not moving up are precious metals and energy. Energy kind of sort of is moving up away from the Colonial Pipeline issue as well, too. The second, I think, story for inflation is surveys. If you look at the regional Fed surveys and the ISM survey, their prices paid indexes are at a 40-year high. The National Federation of Independent Businesses also has something similar. They ask small businesses about their costs. They're at a 40-year high as well, too. So you've got all of those going. The third thing I think would be the TIPS break-even market. The break-even rates, especially on the 5-year break-even, are right at the 2008 peak, about to go to the highest level since 2006, at least on a closing basis. So you're very, very close to 15-year high in that one. And then one of the Fed favorites for inflation is the surveys of consumers done by the Conference Board in the University of Michigan. Their surveys of consumer expectations of inflation are also moving up as well, too. In the case of 1 year forward consumer, what do they expect for inflation over the next year? It's the highest level since the Great Recession. And to underscore that, typically the consumer surveys will track gasoline prices. Now, these are monthly surveys. You know, there is some gasoline prices very high because of the Colonial Pipeline only for the last day. They're not in the survey. But by and large, gasoline prices are not up. So it's a perception that everything else is coming. And then on the fundamental side, you've got a giant budget deficit. You've got a bunch of transfer payments from the government in the form of stimulus checks. You've got a very high savings rate as well, too. So there's the kindling for demand. People have got money. We've mailed them money. We've got high savings rates. If we get some confidence in the economy and they go spend that money, we could get some demand for higher prices as well.
Yeah, so yeah, markets are set up for this, and TIPS break evens, especially the 5-year space, is probably one of the best assets to have held, surprisingly, on a risk-adjusted basis. Its Sharpe ratio over the past year is a stellar almost 4.5 to 1. That's beating out anything and everything. That includes ARC that we were joking about before this call. That beats out major commodities. It beats out lumber that's been, high flying. Crypto, anything you throw in it, it's impressive. The steadiness of that rise has been nothing but amazing. Now, the only issue is...
Hasn't beat Dogecoin.
That's true. Okay, I take it back. Dogecoin, yes.
Yeah.
There's a lot going on that we do have some historical precedent and examples to compare to. A big one is 2010, 2011, coming out of the recession. We did see a very similar surge in commodities that did not lead to sustaining inflation. We also saw TIPS break-evens nicely widen. At those same times, we also saw ISM, as well as many other Fed surveys, printing and screaming about inflation. And historically, those type of surges in ISM and other prices paid type surveys have been a hairbringer of really a demolishment in coming inflation over the months to come. Now, I've slowly been kind of agreeing with Jim, I think, on the inflation outlook, just because there's such huge supply dislocations and there's structural issues at play here. And anytime you hear the word structural and there really is an issue, that means it's going to take a heck of a long time to fix. And that's not something that gets done in a month, 2 months, or 3 months. So that the fact of the matter is manufacturing has such a strange thing going on. They've lost jobs. In transportation, we lost like 74,000 jobs last month, which is just beyond, but sounds bonkers given the amount of demand for truck drivers, different manufacturing labor, transportation, distribution, and so on. So it creates kind of this, I think, a strange kind of scenario for manufacturing where they have limited capacity. They don't have the ability to expand production because they're either running at capacity, they haven't put the capex into it. That's the case of lumber, for example, with all the sawmills, or they can't get the truck drivers and so on to get online to help get these loads. And there's a high degree of loads. If you look at some of these websites that basically match loads to trucks, and I think TruckStop is one of them, there's an incredible amount of loads that are just sitting out there that need to be picked up. But if you look at the chart of trucks and truck drivers that are willing to do that, it's just still plummeting. And that is something, again, structural. It's going to take time, and that leads to higher costs. Shortages, as we've talked about, is a form of inflation. And some of that is going to get passed on to the consumer. So what I'm looking at, for example, we have CPI coming out here, recording this the day before, and CPI is expected to come in around 30 basis points, and that's right where it was last month. You do not get strings of core CPI above 20 basis points that often. We saw it for just a brief time, June, July, August of last year. Not surprising, come out of the pandemic. But this time around, I think we need to look back at some other historical precedents, and that's really only happened since, I think it happened in 06, 07. Otherwise, you're going to go back to the really early 1990s. So stringing together a core CPI above 20 basis points, specifically if we can get it for 3 consecutive months, to me is a game changer, and we'll see if that can happen.
Jim, we're going to turn next to you to give us the case against inflation.
The case against inflation, I think, Ben, you're best off talking about the case against inflation. Give me
Sure.
your 3 best shots on the case against inflation.
Well, again, there's the good old DGT, like we've always talked about: demographics, globalization, and technology. And that's something that, again, is structural and that has had a major, major footprint on inflation and keeping it low. So you can explain a whole heck of a lot of CPI just by looking at the aging of our population, and specifically too in Europe. So you do have, that's certainly a case against. The other one is that we've seen similar rises in commodities. 2011 is the perfect instance. We didn't see it endure for that much longer beyond that period. Now, I'll go ahead and push back a little bit. This is something I kind of wanted to talk about. For us to see sustained inflation over the long haul, we might need some of this demographics to shift. And one thing I think that people are missing is this might actually be happening, and we don't even really realize it. And that is that the aging of East Asia, specifically China, is finally catching up. If you look at their old age dependency ratios, now I'm going to a totally different tangent, hopefully you guys don't mind, but if you look at their old age dependency ratios, basically they're those over 65 to the working age population of like 18 to 64 years old, all of a sudden that ratio compared to Europe and the US is rapidly catching up. I think that's going to have the opposite impact that people have seen since the 1980s with the aging of Europe and the US and really young, cheap labor from East Asia. That could be kind of flipped on its head. And I think it's going to happen within the next 2-3 years, which will mean that we could finally see sticky CPI or core CPI rebound. So maybe that's something to watch. But getting back to the case against, there's just countless examples, unfortunately, since 1980 of every time we've freaked out about inflation, it hasn't come to fruition. It's just that this time around, I think we do have some real structural issues. Demographics might be changing and influencing higher inflation down the road. And then, like you've always talked about, Jim, the fiscal stimulus is definitely different, and the degree of rise in personal income is definitely different. So there are plenty of markers to be enthusiastic about inflation. That's why I get investors are kind of falling for it hook, line, and sinker. And just got to see if we get these strings of core CPI above 20 basis points.
On DGT, I just wanted to say real quick that I agree with you on that. And that's why when we talk about inflation returning, it's important to put this into context because, when you say inflation is returning, if you're of a certain age, you think Zimbabwe, and if you're of another age, you think the late 70s. And then I'd say, no, I'll go with that. We're going to have consistently a 3 handle on inflation. Well, that's not inflation. A 3 handle is like, well, if we get that, it'll be the highest level that we've had in 28 years. I'm talking about headline inflation, 2.5 on core. And if we get that for a sustained period of time and the market realizes it and decides to move those deeply negative real rates to positive, you could see a 3 handle approaching a 4 handle on 10-year notes in the next year or two, that would be very painful for bond investors to have a move from about 160 where we are right now to, the high threes in the next 2 years or so. And so we got to put this into context. I know that when you say inflation, everybody goes, so where's Weimar? Well, no, we're not going to go there because of DGT, because of demographics, globalization, and technology, unless some of those fall apart. And Ben's right about the numbers that came out with the census numbers that came out of China yesterday. They really were quite surprising on how much that they've changed in just the last couple of years. So I agree that will help hold inflation down. And I feel like when I have these inflation debates, we're kind of, maybe not with Ben, but with others, we're talking about the same thing. Some people will point out these long-term big things and say, look, we won't have inflation. And then I'll say, yeah, but I think we can have 3 handle for a while. And they'll go, well, yeah, I think you can have that, but that's not inflation. And then I'd say, well, actually, I think that is inflation because you haven't had a 3 handle on inflation consistently since the early 1990s. And if the bond market reacts to that with a positive real yield, you're going to have quite the move in interest rates should that all unfold like that.
Yeah, and even the very basics of like this, like you've always talked about too, Jim, the stock bond relationship. That's, we've seen that crash basically to zero correlation, which means that investors are kind of on the fence here and also thinking that something's changing, in that the bond market's no longer this great hedge against the stock market. Even on an intraday basis, that's happening. I don't care if you look at 5-minute, 10-minute bars or so on. But I agree. The big thing is that if we can get a stair step higher in sticky or core inflation after a recession, which just has not happened since the 1980s, that is different, and that is a game changer, and that's something investors will have to incorporate in terms of an inflation risk premium into pretty much anything and everything. So, we'll have to see. I think with the Fed, they're going to require what we've just discussed, numerous, strong high prints. I think if we get 3 consecutive really strong core CPI prints, that's going to really be a lot of push the Fed. And remember, that's going to be right ahead of essentially what Jackson Hole. And maybe that would be what is needed in order to see the taper begin, which would be, again, big for risk assets. And so if we can't do that, and we get core CPI, let's say it's a huge surprise tomorrow, comes out as a big goose egg, which would be a shock, just like non-farm payrolls, then we're all right back to the Fed. Yeah, you've been right. Okay, you can sit on your hands. We can keep this kind of easy money going, and stock market likes it, and so on. But if not, then we got something really to talk about, specifically in August with the Federal Reserve.
So let me just underscore one other thing real quick. What you said about the stock bond ratio. There's 70 million accounts in the United States use a wealth manager to manage their money. Why do people go to a wealth manager? I know I'm going to upset some of the wealth managers listening, because those clients are chicken. If they were really aggressive, they just buy S&P ETFs and they'd call it a day, or they'd buy triple Qs and they'd call it a day. So they go to a wealth manager because they want to participate, but also have some protection. And the great answer has been the 60-40 portfolio, 60% equities, 40% bonds, and it has worked great for the last 20 years. Stock market goes up, you get some appreciation. Stock market wobbles, the 40% leg goes up, you don't have as much downside. If that correlation between stocks and bonds goes away, there's going to be a lot of long faces looking at their wealth managers going, why isn't this working like it used to work? And what are we going to do about this? And why is my portfolio appearing to have more risk as you go to a 100-0 portfolio? Both stocks and bonds go up together and down together. And so there will have to be a big rethink about the way that wealth managers put conservative investors into their investments. And that will definitely shake up a lot of how Wall Street operates should that unfold. More inflation leading to a 0 correlation between the stock and bond portfolios.
But that's why they have Dogecoin, right? I mean, that's
right.
That's the other 40% now. No.
Right, exactly. So 60% Bitcoin, 40% Doge. Yep. Bitch and moan that you haven't doubled your money in the last 4 days, and then now you're an investor in 2021.
Oh boy. No, but getting back to it, I am amazed with how quickly all of a sudden investors have gotten into the inflation bandwagon. I will say that just this week, for the first time, we've seen all maturities from 2 to 30 years out pricing in 2.5% plus headline CPI. So over the next 2 years, all the way out to the next 30 years, the probabilities as implied by inflation swap caps and floors says that we're going to get 2.5+% inflation. That's the hottest numbers on record, and this data doesn't go back that far. It goes back to like 2011 or so, but still, that's as hot as it gets. So we're getting a right side tail expected by investors. That's probably why we still have, 60, 70, 80 basis points of tightening expected into 2023 by the euro-dollar curve. And so these guys are going to need to be pleased, and that's going to have to come by way of, some strong CPI prints, or else, the wind's going to come out of these sails very quickly. So again, they're just in need of this as much as anybody in terms of this rock star performance, and we'll see if it can happen.
Well, thank you, Jim and Ben, for your thoughts today. We really appreciate it. Thank you, everyone, for joining us today. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our two most prominent offerings are Bianco Research and Arbor Data Science. For any further information or questions, please contact Gus Handler at gus.handler@arborresearch.com.